In this video, we discuss what a recession does to people in retirement and how you can protect yourself from an upcoming recession. Coming up next on Holy Schmidt.
Holy Schmidt!
The most common description of a recession is when we see 2 negative quarters of economic growth. In other words, gross domestic product, or GDP, adjusted for inflation, falls for at least 6 months. But that's not a terribly accurate description, and one that I don't like to use because, frankly, unless you're an economist, most people don't know what that means. I prefer to use the National Bureau of Economic Research description because, frankly, this is the group that determines if we're in a recession anyway, and their description is much more straightforward. The NBER says that a recession occurs when we have a significant decline in economic activity over several months. In practical terms, a recession is when we have rising unemployment, business failures, and general economic stress. And once the NBER has officially declared that a recession exists, the chances are it's probably almost over because they need about 9 months of data, and a recession lasts on average about 10 months. So in layman's terms, we can assume that a recession is a period when people are losing their jobs and businesses aren't doing very well. What does a recession do to a retiree? Well, that depends on if inflation is also present. Oftentimes, the overheated economy caused by inflationary conditions causes people to stop spending and drive us into a recession. When prices keep going up, people tend to eventually spend less. Think about driving your automobile. You would have filled up your car, and for many of you, it would have cost over $100 in many cases. I will bet that as you filled up your car, you were thinking about ways to stop driving or drive less or share the burden of driving. The same holds true with discretionary purchases like dining out, new clothes, going on big vacations, and so on. And importantly, the government can speed all of this up by raising interest rates. Higher rates tend to make home values go down because when you go to buy a new house, the monthly payment has gone up. Lower home values for existing homeowners cause people to be less comfortable about spending money because for many people, their home is their biggest asset and they keep track of its value. Can you have a recession and inflation at the same time? Yes, you can. It's called stagflation. We'll discuss this in a minute, but let's stick with recessions right now. And in particular, how does a recession affect a retiree? One of the biggest negative effects of inflation is increased unemployment. Employers can't afford to keep their staff on the payroll because demand has gone down and prices, frankly, probably are going down as well. But you say, yes, but Jeff, prices are going up. Right now, the economy is at 8.6% inflation. This is true. But very quickly, we reach a tipping point and stop spending, or at least curtail it. And when it happens big. It doesn't take long, often 2 or 3 months, for an employer to look at the world and say, people have stopped buying what I have to sell. I need to lay staff off. On the surface, if you are a retiree, this is a good thing because the carnage of higher prices has come to an end. This is particularly good if you have a defined benefit plan because your payment is promised to you. It doesn't go down depending on what's happening in the world, in the stock market, the equity market. But what if you have a part-time job? Well, good news. The number of part-time jobs actually go up in a recession because employers still need people to work. They just can't afford to pay full-time workers and the benefits that go along with having full-time workers. A retiree generally doesn't work part-time for health insurance or 401k matching. They do it because they want to supplement their retirement lifestyle with additional income. But even though there are more part-time jobs available, this doesn't mean that yours is guaranteed to stay in place. While part-time jobs tend to increase during a recession, the deck chairs move around a lot more quickly. You may be working for a company that doesn't make it through the recession, and in that instance, you'll need to find another job. Still, so far you have 2 checks, well, at least 1.5 checks when it comes to why a recession may not be bad for you. But what if you don't have a pension that has a payment guaranteed to the retiree? Rather, you have a 401k and the value of that retiree goes up and down depending on what's happening in the markets. Well, if you saw my video from a few weeks ago, you will note that most retirees' portfolios are down between 15 and 16%. At least that's where they were at June of 2022. This is not good news if you're living off of your investments. In a recession, businesses are losing customers, and their share price is going to reflect that. If you have bonds in your portfolio, the story may be different. It depends on when the mutual fund purchased the bonds or when you purchased them, if you purchased them directly. Now, what happens if there is both a recession and inflation happening at the same time, like we discussed earlier? And inflation means that prices are going up, and many people equate the rise in inflation rates to Russian oil, or the lack of Russian oil, as the case may be. But, and this is important, we had inflation before the Russian oil issue. If you remember, for those of you who have Social Security anyway, if you remember last year, your cost of living adjustment was 5.9%. This was set in October of last year for the 2022 calendar year. By December, inflation had run up to 7%. If it was just Russian oil, we wouldn't be running 7% inflation in December of 2021. The invasion had not happened yet. As of May, inflation was running at 8.6%. So a small component of the overall basket is due to the war in the Ukraine. But back to the question, if inflation and recession happen at the same time, what happens to a retiree? Well, first, your cost of living adjustment is going to go way up. The COLA adjustment is not based on the recession, it's based on inflation. So you have partial protection if you draw Social Security, or if you're at the age to draw Social Security but you decided to wait, you still have that same cost of living adjustment protection. What about investments? Well, if you're talking about equity, value investments tend to do well during inflationary times, and growth investments tend to do well when inflation is low. But these are not ironclad rules of thumb. Right now, investment movements are volatile. So what can you do? First, understand your individual risks, because they're going to be different than your neighbors. Frankly, in an inflationary environment, everybody faces similar risks. But during a recession, the risks depend on whether you're working or not, amongst many other things. A mild recession is much better for most retirees than runaway inflation. Next, be frugal for a while and build or continue to build an emergency fund. Consider converting your taxable retirement account to a Roth, because the tax impact will be less when the prices are lower, of course. This is particularly useful if you're just going to take the proceeds from the sale of those investments and put them right back into the same investments. Now would be a very good time to speak with a qualified financial planner. Do your research, of course, but also make sure that you don't take advice from someone you've never met, referred to you by someone you've never met. As I've said many times about commenters, occasionally you'll see a commenter bragging about an exorbitant return. They will also talk about how they have the golden financial planner, and that they are so lucky. That is almost always followed rapid fire by people who are really excited for them, and one or two that absolutely need the name of that financial planner. The person bragging about the returns will invariably break down, reluctantly of course, before they give up the name, but they'll give up the name and a telephone number or something similar. When you see something like that, there's a good chance, a very, very, very good chance, it's not real. Somebody is trying to get you to call them. If the financial planner was a true genius, you wouldn't know their name, or at least you would know how their performance was, because frankly, they'd be day trading. They wouldn't be giving advice to other people. And the last word of advice is to stay calm. As I mentioned at the beginning, most recessions last about 10 months, and you don't even know you're in a recession for 8 or 9 months in most cases. By the time you focus on what to do next, oftentimes you're just about out. Check out this video on the 5 things you should have paid off before you retire. This is Jeff Schmidt. Thanks for watching.